Good afternoon, everyone. Welcome to the FX Hour. I'm Blake Young, taking you through the next hour as we discuss all things Forex. And today we'll be talking about some linear regression and some other things there. And yes, we'll get to some of your questions that are coming through the chats, as well as some of the things we got through the emails. So we are going to be talking about linear regression today. But before we get into that, and before we get any further, just want to remind you that you can follow us at MyTrade. Go to MyTrade, look for the Shadow Traders, and you can follow Shadow Trader, FX Trader, along with the Swing Trader, Pairs Trader, weekly updates, etc., where you get our daily newsletters, our commentary, setups, and other commentary and calendars that are there as well. So you can catch us there and get all of our updates. This is recorded and posted to shadowtrader.net. So you'll be able to find this under shadowtrader.net under the FX Hour. So you find the archives under FX Hour, and that's where you'll find that. Let's go into our charts, and let me zoom in a little bit tighter on this. I think it'll work better. Nope, that's not the right one. Try that again. This is the one I want. There we go. And I did want to do a little bit of a follow-up to our discussions of the pivots. And one of the questions is, do pivots work on the weekly time frames as well? And the answer is yes, they do. And I want you to see just even today's action, today's price action. We've crossed past the R2 on the S&P. We fell back, tested the pivot. We've crossed past the S2, and now we've come back to the pivot again. So we did that all within one day. We jump over to something like oil prices, and we say, okay, what about oil? Because oil, this was a really tight trading day on this pivots, and you do need to make some adapt to the changes that we've seen in the pivots based on the fact that yesterday was a closed U.S. market, and yet we had a date. Our Monday candle really was traded off of the pivots for Monday, I should say. Let me restate that. The pivots from Monday were based on Friday's price action, even though Monday was a closed U.S. equity market. So you can see the trading occurred on the futures market, but not in the equities, and so there's not a lot of activity. And I wouldn't be counting the price action from today, from yesterday's price action. I wouldn't worry about these pivots from yesterday. I'd be looking at the previous pivots, but that previous pivot point and the regression, or the R2 and S2 would have been defined by the previous Friday. And the cross through the S2 is the one that I said we overextended on crude light, and therefore we should come back and retest 93.90 at this point. So I'm expecting crude light to come back and test 93.90. It may not seem like very much, but as we're looking at that, we're talking about 75 to 80 cents. And remember, in futures, that is a significant move on crude light for a quick swing scalp trade, and that's what we've seen before. Now, crude light has had a major impact on the Canadian dollar as well as the pound. And this is we're going to kind of lean into this with the idea of pulling back to the pivots. We're going to talk about the idea of pulling back to regression line. So I'm going to jump over to the pound dollar, and the pound dollar just sold off and sold off and sold off and sold off. So Friday we got into the position. Thought we had higher highs, higher lows. Our pivots were getting higher. Everything was showing that the pound was recovering and going to show a nice bullish move. Overnight, we see that it corrects. We see it break down about 2 in the morning. Our big breakout anyway. Breakout at 2 in the morning. We've dropped, and I want you to see the culmination, really. This is the big culmination of everything that we've talked about over the last few weeks. And that we've talked about pivots, we've talked about fibs, we've talked about stop losses, we've talked about changes of trend. And so here we have lower highs being created. We broke past the S2. And so since we broke past the S2, we'd expect it to pull back to the pivot. Well, the pivot hasn't been established until right here in the next few minutes. We'll see this pivot established. And I want you to notice I anchored the lower highs because we had an uptrend going on, like we defined. Higher pivots, higher highs, higher lows, everything uptrending in the shorter term intraday. And so when we broke through and created a downtrend or created those lower highs, I anchored off the shadows because we're doing intraday, and I hit 3 upper shadows as a resistance line based on our Fibonacci fan reversal anchor technique. And so now that the Fibonacci fan reversal anchor technique is there, we can see it came down and hit the pivot. We can see it hit the pivot again and again and again and again. And so we keep not pivot, the 0% anchor line. So we're watching for it to get to the pivot, but we keep hitting that target line, which is good. That shows us all of this is exactly like we would want it to play out. So all day we keep seeing it hit this target line, the 0 line on the reverse fib anchor, and we're watching for a bullish candlestick reversal pattern. There's something to tell us that we're done dropping. Now we keep hitting our target line, but we haven't given a bullish candle without it. Well, we've only an inside candle. We've not given a bullish reversal candle. We haven't created a bullish engulfing candle on the hourlies. We haven't created a a 3-candle reversal or morning star on the hourlies. We have none of the candlesticks that would give us any confirmation to that bounce yet. And we keep drifting and trading along this target line. So even though I'm expecting the price to move back to 165.17, that would give about a 47 pip move here. That situation there is going to give us a bullish target back to 165.17. Let's see if I can shut that off. I'll have to shut it off this way. There we go. That 165.17 target is 47 pips away, but we haven't got the confirmation that we're done drifting lower. We can see it slowing down from overnight, but it hasn't given us a bullish candle. So now I'm willing to, over the last few hours, start tracking this trend. We have these lower highs going in through here, but this brings us to our regression line. So one of the things that we look at and the discussion points, this is my target. I can see it matches up to 38% and does that by about 5 p.m. tonight. I'm waiting for it to stop falling. I don't want to catch a falling knife. And as we look at linear regression, a couple of things you might note. If we were drawing linear regression channels and we were watching this move right through here, some people would look at this and say, okay, it's always going to revert to the mean. At this moment, if we had to look back to the previous 2 days, this is why I don't use mean reversion. If we were watching the previous 2 days and we saw that it broke through, because here's the candle, broke through the linear regression channel, and there, and there, and there, and there, all those days, those are all those hours, this would have been your linear regression, 166 even. And so when we broke through the pivots and even broke through the S2 at this point, the linear regression at that moment was 165.74. The idea that it was going to pull back to the mean or pull back to the midpoint just isn't a valid trading methodology, because what happens is when you see that linear regression is saying, give me the best fit for the data. The problem is every time we add a new candle, we're adding more data. And so instead of reverting to the mean here, I don't expect that to happen. I don't expect a mean reversion just because the mean is there. I need to see confirmation. I need to see price action move, because our mean was all the way up at 166 during the sideways move. Even at this moment, when we broke through to the downside, it was at 165.76. So as we continue to move this down, lower and lower and lower to our current price action, notice we're still past the linear regression channel, and our mean is coming to us. We've gone from 166 to 165.44. So the mean is dropping and moving towards our target. Right? This is just a linear regression channel, and the linear regression channel is using the time frame that we select. And so it's an adaptive linear regression. Let me show you how this looks. And I'm going to get rid of our, well, we'll leave our pivots on for just a minute. So if we look back, right now, the default is 20 days, 1 hour. If I'm using an hourly chart, it's looking at 20 days, 1 hour. And if I go into our studies, and I'm going to edit our studies, we're going to add in the linear regression channel, the 100 and the 50. It's going to give us these lovely little lines through here. The middle line right through there is the long-term linear regression for the last 20 days. That's the best fit for all the close prices for the last 20 days. You can see that our midline, that's 50% channel and 100% channel, that's basically a half of 2 standard deviations is what that is. If I drew a linear regression channel from the way back here all the way over, you can see it's pretty close, not exactly, but it's roughly that same idea. The same midpoint matches because the regression line matches, and then this would be 2 standard deviations above and below. Now as we're looking at this, all that time frame that we're seeing price drop, creating lower lows, lower highs, even though it looks like we're pulling back to the mean here, I want you to note that when we broke through the mean, we came up and got close to it, but we never got to that point. So the moment that it broke through the mean, we got really close, but we never really got back up to it all the way till we're at today. So we've seen nearly a 200 pip drop, and we still haven't come back to retest the mean. So we can't do it just based on break of the mean. We need to look for the reversals. We need to look for those clues and those signals. So this longer time frame, this 20 days, our current mean is here at 165.08. This big sell-off that we had right through here is barely getting down to the mid channel, the 50% channel. Now, if I change this, I'm going to change the style, and if we just looked at the last 2 days, and still keeping it on hourly. It's going to adjust to the last 2 days. It's going to look at all the ranges for the last 2 days, and this is our linear regression and our mean. Notice that it's slightly downward sloping, even with this breakout, and we're testing this bottom channel. What will happen is, as this candle progresses, if we were to look earlier in the day, our linear regression would be at that level. If we were to look back through this little time frame, our linear regression would have been at this point on this channel, and then each new candle that pushed lower is adapting the mean. It's adjusting the mean, changing the slope of this line because it has to be best fit, and these lines will widen out. And so the idea that it came down and touched this does not instantly tell us it's time to buy, because earlier it was touching it, earlier it was touching it. It was all the way up in this area, and this area, and this area. So earlier in the day when we were breaking through the downside, the regression channels were already at the extreme. And every new candle that we put out here, these lines will widen out to hit the next level. So we don't want to just instantly look at this as an indication that we're at an extended level and we're going to reverse to the mean. It's not enough. This will keep adapting and keep moving out further and further and further. And so we need to watch, if you're going to do a mean reversion, if you're going to look for it to pull back to a key support or resistance level based on linear regression, then you need to have some sort of confirmation, some sort of indication, some sort of end of trend and reversal that gives you the clue that you're going to go back to that level. If we look at the last 2 days, or 1 day, excuse me, we're going to do 1 day and we'll do a half hour. Our lines are now dropping more aggressively because we're just looking at 1 day sideways and 1 day bearish. As we're looking at that downward move, again, magically we're at the 30, right at that linear regression, even though we're looking at 1 day versus 2 days. So it'll always adapt to the time frame you're looking at. The fact that we're down here doesn't mean it won't go out further, it won't widen and won't expand. So if I can get these to match up, if I can look out to the future and say, when I get a bounce, then I could come back to that mean or regression to that mean, then if it matches the pivots, then I'm going to feel a lot more comfortable with that target. Because then I start getting multiple confirmation. Then I will feel that this is done expanding. So until it stops dropping, these are not done expanding. Still like the idea from our pivot rules to get back up to 165.17. I still like the fact that our lower highs have matched up to the target line, but it hit the target line here, hit the target line here, here, and here. So we have 4 times it's hit this target line on our Fibonacci fan, so as we come down to these lows, it's got to stop falling. And when it does, then I'll look for the either linear regression or the fact that our fan matched up to there or the fact that our pivots are now there because we've now adapted to today's price action. We could even throw a Fibonacci retracement off of the high today to the low so far today and look for these to come together. That means that we might see it come down a little further and a little bit further. I wouldn't be surprised to see it come down to this level, call it 164.58. How's this for oddly specific? I wouldn't be surprised to see us test 164.58 because then at that point our Fibonacci retracements, our 38% will match the pivot. Our previous day 61% will match the S2 from the previous day, and our linear regression will come down to meet it sometime by midday tomorrow. And so all of those can come together, but again, we need some sort of confirmation. We've got to stop falling. The trend has to stop falling. And so it always, the trick, I know Norm asked a question on this, the trick here, Norm, is that whatever time frame you select, it will always look like it's a perfect fit, because it is. It's perfect fitting in the past. So if I take any time frame whatsoever, I should be able to find resistance and support levels and these Fibonacci, or not Fibonacci's, these regression lines matching up on about any pair and about any time frame, because that is exactly what the math is doing. It's simply saying match the best fit for this midline and give me standard deviations expansion out top and bottom. So whether I'm on a 1 day 30-minute chart or if I'm out to a daily, I'm going to see that regression line hitting over and over and over again. I'm going to see those resistance and support areas hitting over and over again because it's a backward-looking best fit. And that's difficult. The idea is that if I'm looking at that and I look at a trend, even same idea as a trend line. If I start out with the Australian US dollar and I say, okay, this was a best fit at the time. I hit support, hit support, hit support, hit support, hit support, hit support, hit resistance. This is its favorite level. So if it peels off of there, I expect it to come back to that support or resistance level right through here. And if I just were to trade that, I want you to note, not only does it not come back to it, but it actually gets further and further and further and further away. It would take a significant move to be able to hit that Aussie US dollar level way, way up here. So looking at that is probably irrelevant, because at the time, this would have been the best fit. As we adjust and look over the last year, this is the best fit. And that best fit line, you can see we're right at the average. For the entire year, we're right at the average, we're right at the mean, and that's fitting right where we want it to be. Now, on it says something about the VPOC, or the POC. Now, what are you using for that on the dollar yen? Are you using the, what are you using for your point of control? Because if you use volume profile, that doesn't work. You can use it on the 6J, because then you have volume. Or are you using the monkey bar? Okay, you're talking about the pivots. Yeah. And so in that situation, you're defining what that barrier is. You're defining what the support or resistance is, and you're doing a very specific shorter time frame. Right? So if I look at the 6J and I look at the point of control for the last year on the volume profile, so now we're including volume, we're talking about 0.009797, which is going to be roughly 102 on the dollar yen chart. So we might expect it to retest 102 if it gets back inside that value area. But when we're talking about the pivots, oh, and I just note the regression line is right here. We're not expecting it to pull back because this was a breakout. This yen in this situation lost its strength, broke through key resistance on the dollar yen, key support on the 6J, and is dropping. So now we're looking at the next support area all the way down here at 94.90 from the longer time frame. But as we jump back and look at that dollar yen, this is a great breakout. We still have potential to get all the way up to this level up here, and we might find some resistance at the 50% channel near 105.50 over the next day or two. Great, let's look for that, let's watch for that. But when we're getting back into the idea of using the pivots, using the dailies here, and we're using the pivots, now we've got to go into the shorter time frame, whether we're using hourly, 30 minutes, or anything. We've crossed past the R2, and it's not just today's R2, because again, yesterday was a closed day for the U.S. equities and it caused tighter volatility. I wouldn't trust those pivots, but I would trust the previous days. So we're past the 2 previous days pivots. We've touched that resistance channel up here. Have we given ourselves confirmation that we're reversing? Because we need both of those. We need a reversal for our regression channels as well as for our pivots. The fact that we're overextended based on our R2 either day, the fact that we are overextended based on our channels for the last 10 days, I think it's 10 days on the 30 minute. Yeah, 10 days. For the last 10 days, have we bounced off of it? Are we seeing the reversal here? The fact that we traded sideways, we overextended to the top, that's what both our channels and our pivots are telling us. The fact that we've reached those high points and now we've broken through the near-term support, maybe that's enough right there. That bearish candle that we just finished at 3 minutes ago, that broke down, closed below the previous highs. Now, the way we look at that as a reversal for the pivots, we'd look for it to get back to 104.84. That's where that pivot is. The last 10 days, and again, it all depends on what time frame you're looking at, because the last 10 days mean reversion is all the way down here at 104.62. If we fell back, tested the pivot, and decided to go higher again because we had such a strong breakout, we might not come back to that mean. The pivots including just yesterday's price. The regression channel is using the last 10 days price. And so the idea that it's going to come back to that mean, not necessarily going to happen. A great example again on this is its own history. As you can see, we broke above, let's see if I can zoom in on this. We broke above the mean here at 102.79. We never came back to that mean, 102.79. As we rallied to say, oh, let's wait till we, oh, sorry, right here, 103, sorry, 103.20. As we broke through to 103.20, if we were watching for it to get overextended by hitting the upper channel, watch what happens. We trace up here, We hit that high, and at that moment, at 103.94, if we said, fine, the mean now is 103.30. We're not coming back to this mean. We're looking at 103.30. At 103.30, the mean just keeps coming up, coming up. So when we did revert to the mean, it was 103.50. We've given up 22 pips. In fact, the pullback from the time we got the confirmation was only 34 pips instead of what could have been 50 or 60. So half of our trade disappears. Yeah, and that's what I'm trying to get across, Money Miser, is that both linear regression and the linear regression channels are constantly adjusting. It is dynamic. It will adjust to what price action has happened. And I see way too often people play the mean reversion game because they'll say, oh, look how perfect it fit. Every time it hit that upper channel, it came back to the mean. Hit that upper channel, it came back to the mean. Beautiful. Hit the lower channel, it came back up to the mean. By the time it came back up to the mean, the idea is that the mean has moved. And that's kind of what you have to watch for. So linear regression is a tricky game to play. And there are ways we can adjust and move around it. But let me first off, let's go through a couple of the things that have come through the chat here. And I do want to talk about Scotland. Just reading the chat. Do we have a time profile? I don't know if we do unless it's in the monkey bars. Time series forecast. I don't know if that's what's going to do it for us. Nope, that's not it. All right, I'll see if I can pull something here. Let's look at the ZB and let's talk about Dave's ZB, and then we'll hit the 6B. And bonus, I want to talk about the 6B in conjunction with Scotland. So let's first off hit the ZB. ZB US bonds, and I really like US bonds because it is critical to the US market and our strength, and it is one of the ones that have been seen gaining strength previously until this week. So notice, if we go back to the dailies, ignore the pivots for a minute, you see that the dailies are getting higher highs, higher lows, higher highs, higher lows, and we keep making these highs, but today, major sell-off. Major sell-off in bonds. So if I drop this back into that 30-minute chart, I want you to first off notice on the intraday, we've fallen back, and based on the last 10 days, we are at these lows. But again, this is widened out. Since we hit that, it's dynamic. It will constantly move out. So it is. If you just, no, the drawing tool is not dynamic. The channels are dynamic. The drawing tool, from whatever time frame you hook it on tilapia, that's what it's going to say. It's going to stay at that level. So if I draw a linear regression channel drawing tool, like so, it's already anchored in time, and that's where it's staying. And it's a great one to kind of see, practice. That's what it comes down to. When you see something hit a target, when you see something widen out or constrict down, then when that happens, draw a channel on it and extend it to the right, and then see if it ever comes back to your linear regression. Because in a strong trend and a strong breakout, it's not coming back, at least not in a reasonable time. It's the old adage that the market can stay irrational longer than you can stay solvent. The mean comes to you. So here we are on the bonds, and we see that we're hitting the bottom channel on the last 10 days. And whether I'm using the last 10 days, or if I'm using the last 5 days, or if I'm using the last 20 days, 20 days not quite yet. So all those other time frames, 10 days, 5 days, we're seeing a test of the 10-day low, the expansion. That's where it's hitting, but it's continuing to expand as long as it continues to move out. Now, based on the pivot rules that we talked about, we're past the S2. Notice that even yesterday it came down, test the S2, came back to the pivot. We're now past the S2 again, and both of those days. And now we're at these lows, we're looking for it to come back and test the new pivot that's going to open up today. That is not linear regression. It is not reverting to the mean. It's simply a pullback to the new adjusted value, the high-low close of the previous day. So this is the fair price. The true price is oftentimes used, and that true price, by the way, is also the thing that's used in calculating CCI. So if you like the CCI, that's where that's also used. So as we see that test this level, the pivot is kind of a one-day true price. And that one-day true price says I would expect this now that we've dropped down to these lows and have become overextended based on a one-day move. Notice the overextension started here, 139.11, and we've dropped and dropped and dropped and dropped. I would like to see it break the trend that's leading into that, and I might simply just draw a trend line off of those highs and say let's close above this line. If it closes above that line, I'm going to look for ZB to pull back to 139.02 in the short term. Let's look at the 6B. Now you're talking about the pivots on the 6B, correct? So looking at the 6B, we are seeing, again, 10 days, we're dropping down to these lows based on the 10 days. 10 days is pushing lower. If we did the 5 days, it's going to look similar. And we're down at these lows, and again, these have expanded out. And even though I think it's overextended, I think we should pull back to 165.20 based on the futures prices. I would like to see it stop falling. So after it breaks through this trend resistance and gives me a close, that's a 5-minute chart, by the way. If it breaks through that level, I'm looking for it to get to 165.20. I could do the same thing on the hourlies, but I might be a little bit late to the game for it to pull back to that 165.20. But I'm looking for it to end this downtrend. And if it does, there's a move potentially, as we already commented on, that you can see a move potentially of 50 pips, 50 quick pips up. So the big sell-off, it really was the perfect bad storm. 2 years ago, 2 years ago? 1 year ago, actually. 1 year ago on Labor Day. I can't remember if it was 1 or 2 years ago. It was 2 years ago. 2 years ago on Labor Day, we had a massive mudslide go right through my neighborhood. Blew out people's windows, filled basements up to 15 feet of mud. It was crazy. But it was that perfect bad storm. We had a fire up on the hill. We had a huge hailstorm come through that broke up all the ground, and then it was followed by a supercell of water, and it just created a massive mudslide that ran all the way down through our neighborhood. That perfect negative, bad, terrible storm all came together. The odds of that happening all at once were next to zero. We're not in a floodplain. We're just in a situation that we never should have seen that happen. But things happen. Statistics don't care, or better said, future actions don't care about statistical reference points. That was a 1 in 100 million situation that all of those things aligned right across the same burn scar that happened from a fire that happened right at that time and a break of a berm that happened up on the hill. Well, the same thing is happening for the pound. The pound is in a situation where we have Scotland, who is about 1/10 of the GDP of Great Britain, or the UK, I should say, not Great Britain, of the UK. Scotland's talking about leaving the UK as far as its connection economically and leaving the United Kingdom, becoming its own little kingdom. And in doing so, they're talking about what does that mean for the pound? And as they're talking about this, we're talking about, let's say, California seceding from the Union, right? And so at the same time, what do we see? We see crude light get clobbered. And on the dailies, you can see that daily move is much more dramatic. Let me get rid of just see this much more dramatic day. Today alone, crude light bearish engulfed 1, 2, 3, 4, 5, 6, 7, 8 days, 9 closes. 9 closes. So 2 weeks of price action in 1 day. So you have crude light selling off very quickly. At the same time, you have the situation with Scotland. And like I said, it's like California saying, we're done being part of the United States. We're going to have our own GDP. We might use the US dollar, but then again, we might use Chinese yuan or renminbi. And that would be similar to what we're talking about. And so that change and that shift economically and the fact that crude light is dropping and selling off, that really hurt the pound. And so this perfect storm, in a bad way, has pushed us back down to this linear regression channel line. We broke through the support area. This is a channel line support. It matches historic support and resistance, and this is kind of where it stalled out. But remember, this is a dynamic tool. So what's going to happen is we're going to drop off this little day tomorrow, and we're going to have this day added to it, and the next day we're going to add on to it, and what will happen is this linear regression line will shift slightly down, and these lines will shift wider. These lines were inside earlier. If we drew a channel line, you could be able to see it. Earlier, it would have looked like something like this. And we broke through those downside channels. And so now we're running down and we're testing these lows, falling down at this level. I wonder if it'll let me edit properties. Yeah, see, it's one. This is set for 1 standard deviation. We can change it and make it match better. But if we were watching this going into the close yesterday, and what I'm going to do is I'm going to edit the properties to 2 standard deviations. This again will give you the idea that you don't want to just simply go after linear regression. There's 2 standard deviations. Right there. And as we add, notice how it's shifting? Watch carefully. Because I'm going from this day to this day. Now that moved out. See how it moved out? It has to include the next price data point. Just like that. And so the idea is that you have to have some sort of confirmation. This is still expanding. I do think this is oversold. I've thought the pound has been oversold for weeks. Economically, yeah, this could be a problem, but Scotland's talking about continuing to use the pound. They're still part of the same infrastructure. They still want to use the pound as their main currency, and they may split off and go to the euro. But I mean, we have the other problem. You have the Ukraine. I mean, how bad do you have to be, or how worried do you have to be about the eurozone when they offer you to join? When they offer Ukraine that they can join the eurozone, and they look and say, yeah, things are pretty bad for us here, but yeah, I think you'd make it worse. I think joining the eurozone would make it worse. That's not a real vote of confidence, if you ask me. And I'm sure they look at how problematic it was for Greece and the restrictions they put on them and the austerity measures when things got tough and everything else in the way they controlled them and demanded that they do certain things, otherwise they wouldn't support them. And so I'm sure they're looking at that and saying, this is not a good thing. And so they've stepped away. Now this is what we're seeing on the British pound, or the crude light, and we're seeing it impact the British pound. But in the end, I'm still looking for the pound to be stronger than the euro. So we look at the euro pound, and even though the euro pound is set up for what I'd consider a double bottom, as we create this, let me get rid of all the pivots here. There we go. Even though this is set, there we go, setting itself up for maybe a double bottom reversal. This really bullish candle, if it fails to clear 80.25, I'm still pro pound bearish the euro, and I expect this to roll over and drop further. And you talk about the construction spending, or the PMI manufacturing, it is causing some weakness in the pound. I would agree with that. But you got to remember that today their manufacturing data, they missed there, but their construction data was better. Net lending to individuals rose. So they've done, that was yesterday, by the way. Today their construction spending is up, went from 62.4 to 64, blew the doors off expectations. And yes, their manufacturing is slowing, but it's still above 50. Anything that's above 50 is expansion. It came in at 52.5, so it missed expectations. Yes, there's a little bit of a downtrend going on, but compared to what I'd expect for the eurozone, they also missed manufacturing data. They also fell short. And so this move here is being driven, I think, almost exclusively based on the hype and fear or not, I wouldn't call it fear, the hype and expectation that they're going to see the Scottish vote to leave the UK and then move their currencies, which is significant, move their currency over to the euro. And so that shift in demand could see a 5% move. We might see this retest 84.50, 85 if that were the case. And this big bullish move today still can be tied almost exclusively to the pound weakening. So any failure here, I'd still be leaning to the longer term fundamentals that would say that the pound is going to be stronger than the euro over the time being. Now let's take a look at a couple of these other instruments. So looking at, we already did ZB. Let me do ZN, the 10-year Treasury. Similar sell-off. Now remember, a sell-off here, what's going on when the prices drop? When we have a breakthrough near-term support and prices are dropping, it means the 10-year Treasury yield is going up. They go opposite direction unless there's a monetary policy shift. The bonds and the yields go opposite directions. So we see the bond prices dropping, yields rising, but the overall trend still appears to be down. We've had these gap ups before, like this, like this, like this, like this bullish move, like this, like this, like this, like this, like this. But the overall trend for the treasuries is up, and the overall trend for the yields is down. So it is a significant move today, and evidently we're not putting money into the bonds today, but that's still overall fairly supportive. Let's go over to the gold contracts. Gold breaking through support, and this is why I think, if you have yields rising, why would gold be dropping? So that's a great question. Where are we? Let's talk about these things. If oil is breaking down and gold is breaking down, gold broke through its support today with gusto. Lots of volume behind it. So we see this big sell-off and a breakthrough support. If gold is dropping, well, if we really thought interest rates were going to climb and we're betting on it or hedging against it, and we saw a big move, in those prices, then we'd also expect to see gold go up because it's a hedge against inflation. Right, this is a situation where we are afraid. Just like you're saying, this is all dollar strength. The dollar is getting stronger and stronger. Now, the dollar wasn't the strongest of all the currencies today, but look at this trend. The dollar has gone from annual lows to annual highs and has reversed its bearishness, has gone from here to here. Annual lows to annual highs in 84 trading days. Call it 3 months. Well, almost 4 months. So in 4 months, we reverse from the lowest point to the highest point, from the one of the weakest currencies to one of the strongest currencies across the board. And so the dollar gained this much strength against other currencies, which is about 5%. But theoretically, everything quoted in dollars should see a similar 5% drop in that same time frame, roughly. Now this is a 10% drop in gold. You look at oil in the same time frame from the April-May time till now. That's about a 11% drop. So that tells us what that tells us is if the dollar is gaining 5% against all the other currencies, but gaining 10% against the commodities, that means commodities are dropping in prices as well. That is disinflation. And so when we see disinflation, we see the PPI numbers come out today, and the PPI numbers for France and the Eurozone and Germany have been in the negative multiple days now, multiple months. Multiple reports, maybe that's the way I ought to say it. But we've seen those come out and we see, wait a minute, there's disinflation going on. And if that disinflation or deflation, depending on which way you want to look at it, disinflation means slowing of growth to the point where there's no growth, and deflation means it actually goes into the negative. When we start seeing that deflation or disinflation, we know that inflation is not a concern. In fact, the other is a concern, and the other can cause more damage to an economy than inflation can. And so, like I said, the Eurozone's PPI month over month was negative 0.1. We saw the same thing in Germany. We see that weighing down the economies. That means everybody's looking for a safe haven. And what's happening? They're rushing over and putting their money in the U.S. dollar. And as they put the money in the U.S. dollars, we say, okay, where else is it going? It's not going to commodities. It's not going to gold. It's not going to oil. It's not going into equities. In fact, as we look at this, volumes are traded flat and prices traded flat right at this key $2,000 mark. There is a psychological barrier here. And we start seeing that set up. Now, Money Miser, I would say I'm going to agree with the doomsdayers when it comes to that. If we do see an inverted yield curve, whether it's self-fulfilling prophecy or it is simply a function of the fact that you can borrow short-term cheaper than you can long-term, so there's no motivation to lend for the long-term. 10 out of 12 times that we've had an inverted yield curve, it has been followed by a recession. So watch that yield curve. That's an important thing to watch. Watch for the 2-year, 5-year, and 10-year to be a higher yield than the 10, 20, and 30. Well, I should say the 1-year, 2-year, 5-year, 7-year. If those start to invert, that is a, could be a self-fulfilling prophecy, but it is also that there's no incentive from investors to invest long term if they can get a better yield or better return for a 5-year. So S&P flat. And we're seeing this now, mean reversion game. Let's do the mean reversion. How long, at what point, and we'll just start with the regression channel line, or regression line. Got up to there, can't really mean revert because you're already up at the highs. It's not until we see this move here, when we start adjusting for this, how do you mean revert to this? If we're overextended, you can't really mean revert because we're already at it. Regression channels don't work over this year time frame. It is so overextended. It's so bullish. People talk about the move that we've seen here. This has been going on so long and been so aggressive, like we said, I started saying before. The move that has been 20% for the year, 21% for the year, which is outside of normal and higher than normal. When we look at that and you say, okay, this outside of normal, it's too overextended, the problem is the regression line catches up with it. It adapts. And so as it adapts and you see that move, well, we're just right at that level. Great. The average has come up to us. The average is adapted to us. That's really what it comes down to. So mean reversion is not going to help you at all unless you happen to spike up and hit 2100, 2200 here in the near future and then look for a mean reversion back to support. It has to drop down to 1900 before you have an upside target of mean reversion, but then that mean reversion could, or that linear regression could keep moving away. And I agree, Money Miser, we've got to see at least a 10% correction to shake out some of the bears and get the market a little more stable. We keep seeing these pullbacks and none of them are 10%, are they? Look at the high to where we're at down through there. What is that? 5%. I think the biggest one we had was 6. Yeah, about 5 point. Yeah, call it 6%. So we had a 6% correction. We haven't seen a 10% correction. I think a lot of people are watching for that. Yeah, so our biggest correction has been that far. So commodities aren't getting it. We're seeing this sell-off, or sell-off of crude commodities, gold, the pound, and those currencies associated with those, including the Australian dollar. Look at the Australian dollar, or the New Zealand dollar. Big down day for Aussie. And frankly, is a little bit of surprise, right? Now, one of the things we've been watching with the New Zealand, we've been watching it for it to come down to its clearer or stronger support area. And so we look at this and say, okay, we're looking for a potential correction. If we look at some support or resistance areas, that 38% area, I'm going to cut off that low because we have more touches down here. I might look for it to come down to 81.21 at this point. There is another support area through here at 82.73, but looking at the linear regression for the year, going off a year ago, are you willing to bet long back up to 86.58? So this breakdown, if it comes back to test 81.21, I don't expect it to get back up to 86.63. I expect this line to flatten out as time goes on, as we get more trading days, and then I expect it to invert and start to drop. But the New Zealand dollar is definitely selling off, and we could look at a shorter time frame, and we could look at the trend down through here, and this is where we might start combining things. We might start combining the idea of looking for support and resistance. That's why I draw channels, because I feel like I can lock in the price actions, the support and resistance that I trust more. Rather than just the mathematical best fit, I want to know where it hits support and resistance and how I can benefit from that move. So as we're seeing this breakdown and sell-off, I do expect it to come back down. First off, got to test 82.76, but then potentially down to 81.20. At which point I would be willing to buy without looking for a bounce, without looking at confirmation, because there's so many touches down there. But as an added benefit, I can look at the market forecast, look for the clusters, look for the reversals, and look for a break of this falling downtrend. Yeah, on crude light and the USO, that breakdown, I mean, it was doing super well yesterday, or Friday. And then we came back down. But I want you to note that we did come right back down to the same support area. We've been here before. We've established that as support. And it slammed down into it. The question is whether or not crude light holds at its support area right through here as well. Because we have that support area, and you can see it kind of matches up to some other levels. Definitely matches up to this noise back through here. But if it breaks through there, there could be one more push lower at 91.54. The question is, does that give us enough time to recover before your options expire? I don't know, because we fell so quick. We bounced up. It looked beautiful. It looked like a reversal of trend. You could have even anchored that and said, look, we ended our bearish trend here. It looked wonderful reversal. And then today, we come crashing back down. And there's a lot of things going on. We saw China's report saying that they're going slower. And every time that they say they have slower growth, all the commodity countries get hit. Crude gets hit, gold gets hit, Australia gets hit, New Zealand gets hit, main trading partners of China. And so we see China starts to slow down. We have the problem, or the concerns with Scotland, but then we still have the problems that they've raised their terror alert in the UK, and so that's certainly impacting them. We also have the Eurozone slowing down. We see that Ukraine doesn't want to be part of the Eurozone. Russia's still invading in Ukraine. We still have ISIS moving across, and we still have the Israel-Hamas situation. Yeah, and Money Miser says, and don't forget that we still have more China and Aussie reports tonight. We have the home prices out of China, or no, not the home prices. I'm sorry, PMI, Purchasing Managers Index, out of China. We also have Australia's GDP, and then they also have their governor speaking out of Australia, the Reserve Bank of Australia's governor. There, Janet Yellen is speaking tonight, and all those certainly could add some extra traction to the Australian dollar. But if we don't see some indication that we're going to have growth in China again, or that we're going to stabilize, then oil might break through these lows. Now, as a buyer of gasoline, that could be a really good thing, but as someone watching commodities and inflation and now deflationary pressures, a break of this support could push us back down to 88 and even all the way down to 84.62. If we were to look at this as a price pattern, trying to combine all the things we've talked about in the past, my Fibonacci extension just simply measures from the height of the low and gives me a potential target. Theoretically, oil prices could fall all the way back to 78, which would take us all the way back down to the lows that we saw in 2012, if this price pattern plays out. The problem is, that is a problem. That is some extra pressure on the market. Looking at the weeklies, this is your retail gas. Now, someone has to explain this to me. Why have we lost 50, 60 cents on retail gas futures? And why is the gas at the pump not adapted 50 to 60 cents down? Because evidently the refiners are certainly making an extra buck right now. So here we are falling back to these lows. We find that support area. Retail gas futures are way down. And so now if we break through there, we could go down to 195. You can do some quick math in your head. If you're paying 70 cents more for federal and state taxes than what you're seeing on the retail gas futures, then if it drops down there, theoretically you could see a 55, 60 cent drop, and we could be back into the $2 or $3. Yeah, it takes a few weeks, but you know as well as I do, it doesn't take 2 to 3 weeks for it to get up. It takes 2 or 3 weeks for it to come down. We didn't go through the euro earlier. Thanks for bringing that up. Let's do that. I do want to point out, again, this is a 3-year low that we're talking about. Going to the euro-US dollar. Euro-US dollar trading flat again. This low where we're at is matching to the 131. I've talked about 131 for weeks and weeks and weeks and weeks. When we were talking about breaking through 134, I said if it breaks through 134, it's going to go to 131. Now we've stalled here at 131. I'm waiting for this bounce. I'm looking for the bounce. I want to see a bounce. I want to see it just feel like it's overextended a little bit so that we can sell near 132.20, 132.25, maybe near these trend resistance right through this area. And if I can sell off of that area, then I will be looking for it to drop down to 128 and some change. And that 128 and some change target, it ties us back down to these lows. I didn't mean to draw that as a extension. I meant to draw it as just a resistance trend line. And so if we can break through this level, 131, which is a psychological level, and previous support and resistance. Then the next target that I'm looking for is about 128.25. 128.25. I'd be willing to look at this as a potential buy opportunity down here, but right where we're at, we've bounced off it on the way up, but we've only bounced off of it once on the way down. We've overshot it multiple times. So as I'm watching this, I don't expect a bounce here that is significant. I expect, if anything, a short bounce off the weeklies and then a drop. And if it can break through the 131, again, 128.25 is a target that I'd be looking for. And I don't blame the gas stations or the refiners. I just think it's comical, shall we say? Because they get gas deliveries every day. You can't tell me that they're not emptying those tanks. That it takes them 3 weeks to empty those underground tanks. All right. So the euro US dollar, if we break through 131, 128.25. Let's look at, we already did the pound. We already talked about the Aussie New Zealand. So let's go to the dollar Canadian. Canadian dollar was finally gaining some strength, and today with oil prices dropping, it's reversed back up, and this pullback has cleared more than 50% here, so I'm looking for a retest of 109.80, and if it breaks to 109.80, then next side, I don't know if we'll stall this time at 110. If we do stall there, then it's probably temporary back to 109, then back up again. If oil prices break through the support, look for the highs of 112.77. Now that leaves about 300 pip move from where we're at currently, and crude light could make its decision whether it's breaking through support or not before we test this resistance area, and that would be a strong fundamental, not directive, what we're doing, maybe fundamental early cue that we're going to see the dollar CAD retest its highs. This one, like I said, some of the stuff was just a surprise. This one I was looking at, I wanted to take it short yesterday, but it still looked like it had some upside potential on the Aussie Swiss. So I looked at the resistance line. I like this one a little bit better. This is in the newsletter yesterday. So the Aussie Swiss hit its resistance, pulled back, hit its resistance, pulled back, and we're getting really close to that resistance, and I was looking for a short near 86. As you can see, this little price action move here, we tested the 50, pulled back, bounced, broke out, tested the 61, pulled back, and then we hit the 100% almost perfectly yesterday, but I expected another push, like I said, about 86.15, 86.20, and then we got this great big bearish reversal today. So the Aussie just gets hammered, and at this point, I don't know if we're going to be able to get back up to those highs. So I don't know if I'll be watching for that at this point. I might be looking for a lower high where we can put our Fibonacci fan on there. And if we get a lower high with the Fibonacci fan, then I'll be targeting all the way down where the Fibonacci fan and the previous support area, and maybe near 83.60, matches up. So instead of just looking for a trend support retest back through the 84.45, it could set us up for a bigger drop down to 83.60. But watch for a lower high. This was probably a little bit over aggressive. Gold broke out. We still have some bearish pressure. We still have some waiting on this. And the Aussie Swiss, both the Aussie and the Swiss gain some strength from the gold prices, so it kind of filters out gold alone and sets up that opportunity that way. No, I didn't. So I didn't say go. Remember, I said I'm looking for a pullback. Go read every single commentary. I talked about the fact I wanted to bounce so I could sell off at 132.25. I wanted to bounce here. I want one. I still do. I want to bounce so I can sell off into the 128. And it's on the My Trade. You can go read it. I do want to bounce. I did think we'd get one too. It's a low risk spot to trade, but it's traded flat there now. So, I do want a bounce. I want a bounce, but the overall bearish pressure is there. It's just short move up, because we did talk about it on the, you're right, we did on the pivots, didn't we? So the pivots, is that a trend? No. Remember the pivots, the things we talked about in the pivots last week, we did talk about bullish. And we hit our target as the bullish, because we said it was overextended, recall? And we expect it to hit the pivots. So when it passed that pivot point, we said it should go up to the, or past the S2, we expect it to go up to the pivot. That's not a big reversal. That's a quick move. And that's, I think if you're talking about last week, that's the move we were talking about. If you hit the S2, close past it or move past it, we expect it to pull back to the pivot. So on the pivot, quick scalp. But of the fundamentals, the long-term trend, I'm still watching 128. So you are right. I did call a long euro, but it was a very quick move. It wasn't the longer-term multi-week trend move that I'm talking about here. So I'm looking for the euro US dollar to drop, to bounce up maybe a little bit, but I'm looking down to 128 if it can clear that support. So you're right. I did call a long, but it was a long back on a pivot, so it's an intraday chart. All right. Dollar CAD, we didn't hit the dollar Swiss, and I do want to hit the dollar Swiss because I want to talk about the dollar Swiss, and then I want to talk about the euro Swiss, because the dollar Swiss is stalling out right through here. We've seen the same thing that we're seeing on the euro. This would be a bullish move on the dollar Swiss if we can break through there. The next major resistance area is not that far away. It's only 92.30. And I wouldn't look for the full 94.54. I'm probably looking for 93.83. So let's mark that on the chart. Actually, let's mark it right there. What is that? 93.75. So I'm not going to be surprised to see a test of 93.75. However, we've got an interesting situation here where the Swiss, and this might help that dollar Swiss hit its target. So as we're looking at this, let's look at this on the euro Swiss. And does anybody see a problem here on the euro Swiss? I want you to think back in time. There's a magic number that the Swiss has been very clear about. Can you see it? Can you see the magic number that matters to them? This right through here is not erroneous data. That's legit. That's actually what the euro and Swiss did prior. The Swiss banks said they would not let the euro Swiss go below 120. They put a magical peg at 120. And that's what we've seen over and over and over again. So we're looking at this magical peg at euro Swiss. At 120. Now that area, that support area, is one they said they would defend. And so when we look back here historically, they said they'd defend it here because that would be too much strength for the Swiss, and it'd mess with their exports, and it'd mess with their value, and it'd hurt them, so they don't want that to go through 120. So don't forget that as we approach this, because we see this lovely bearish trend, and we see things selling off. And as we approach that, I might not still might not want to buy the euro against the Swiss, even though I know that the Swiss franc is going to try to, or the Swiss banks are going to try to defend that, potentially. They may change their mind. It's been a couple of years. They may change their monetary policy, but if they are going to defend 120, then this dollar Swiss will also go up. So if we're afraid of the Eurozone and we expect the Swiss to weaken their currency so they can keep everything healthy between their trade balances between the European Union and the Swiss economy, then this will likely go higher because they're going to weaken the Swiss. What does that mean? If they do it, if we see a pullback, then I'd like to see a pullback to 91.44, if not back to 90.80 over the next couple of days. And if it finds support there and we have an opportunity to buy, remember that Swiss getting stronger. So if the Swiss gets stronger and pulls this chart back to any major support or support trend line, 91.50 or 90, well, I still like 90.80, 90.80, 90.85, somewhere in there. Those are potentially opportunities. And if we find the Swiss pull back to those areas and we find that support bounce, then at that level, if we can catch that bounce, then the Swiss loses strength because it's trying to weaken it versus the euro, but the dollar is probably the go-to instead of the euro. And so the euro doesn't strengthen a lot, but the US dollar does, and the dollar Swiss could spike higher. If we go back historically back through there, you can see back in those time frames, in roughly those same areas, that's when the dollar Swiss strengthened dramatically. And your point as well, going back there again, April, May, June, when they put the peg in, April, May, June, when they kept trying to weaken the Swiss franc, even though it wasn't moving on the euro, notice this, April, May, June. all that time frame, the dollar was the go-to, the Swiss was weakening. It just wasn't weakening comparatively to the euro. And that April, May, June time period is also, as was already being pointed out, we put in a base here on gold. It did spike higher, April, May, June though. April, gold prices broke through support. April, that same first week of April, right here. Gold broke through support and dropped about 5%, found a new support area. And when we rallied again over here in February of 2013, gold broke through support. Now, it doesn't mean it's directly correlated, but you got to remember that the Swiss hold a lot of gold. So if they want to weaken their currency, one of the things they've done is they've sold off gold, and they got rid of their gold, a bunch of their gold reserves during that time frame to weaken their currency. So could be some real long-term opportunities that could be setting up right around that 120 area. All right, my friends, look at the time. Time flies when you're having fun. So take-homes. Or take home, since you're home already. Takeaways. I like the euro down to 128. Takeaways. The Swiss, if they decide to defend 120, the Swiss could weaken, and we could see the dollar Swiss rally up to annual highs. It could also be correlated with some further selling of gold, which means gold and oil potentially down further, back to annual support levels. I did want to make a quick comment. If you are, as far as stop shopping, remember that if you're seeing a support area and you're seeing that, well, so are numerous people in the market. They don't have to be able to see your stop to be able to do it. The fact is there's areas that we all see support and resistance, and so if we put our stop just outside there, someone else might have stops there, and when we break that, it starts clearing out stops. And when that happens, it clears down to those key levels, and that oftentimes the case. I don't really speculate on stop shopping as much as I do that we have groupthink and mental, the herd mentality at key support and resistance areas. And that's why usually when it breaks through support and resistance, it breaks significantly. So definitely things to watch in the market. Linear regression, remember the mean oftentimes comes to us, not necessarily that we return back to the mean. So those are all some things to kind of take away with you today. We will talk again next week. And as it might happen, and they might see those stops, but generally if you're within 10 or 15 pips, you need to be aware that you're probably right in the same range as a whole bunch of other buyers and sellers, and that's something to be cautious of. So this is recorded and will be posted to the FX Hour under archives under shadowtrader.net. We'll look forward to talking to you next week, same time, same place. Let me know if you have any questions. This regression discussion was based on an email, so you can certainly email me at fxtrader@shadowtrader.net. Have a great week, everybody, and hope everybody has a very successful week. Thanks.